All right, let's talk about something huge, buying your own home. If you've ever dreamt about it but then got totally overwhelmed thinking about the money side of things, well, you're in exactly the right place. Today, we're going to slice right through all that complexity and give you a clear, simple map that leads straight to your new front door.
I mean, it's a massive milestone, right? But let's be real. The whole process can feel like a giant, confusing maze. You've got a million questions, a bunch of doubts, and you're probably wondering, where do I even begin? That feeling of being a little bit lost, we're about to fix that right now.
See, what you really need is a guide, a simple, step-by-step path to follow. So in this explainer, we're going to break the entire home loan journey down into easy, manageable pieces. We're turning that confusing maze into a straight road. Okay, so our journey kicks off with the most important tool you're going to use, housing finance. Just think of it as the vehicle that's going to get you to that dream of homeownership. But what is it exactly? At its core, housing finance is basically a loan that lets you buy your dream home today and pay for it over time. Every month, you make a payment called an EMI, which stands for Equated Monthly Installment. It's this incredible tool that takes the massive cost of a house and breaks it down into bite-sized monthly chunks, making homeownership a real possibility for so many of us.
And here's the whole journey just at a glance. You find a place you love, you apply for the loan, the bank does its homework on you, and if everything looks good, they approve a huge chunk of the cost. We're talking 75 to 90% usually. You pay the rest as a down payment, and boom, your monthly EMI payments kick in. Sounds simple enough, right? So let's get into the trickier parts.
Okay, so the first major checkpoint on this journey is the bank's eligibility check. This is where the bank decides if you're a safe bet. You can think of them as the first gatekeeper you have to get past.
And the key they use to unlock that gate is something called FOIR. It stands for Fixed Obligation to Income Ratio. I know, it's a fancy term, but all it's really asking is how much of your monthly paycheck is already spoken for. Banks use this to see if you have enough wiggle room in your budget to actually afford a new home loan payment without struggling. It's all about risk for them. This visual makes it super clear. So that bar on the left, that's your total monthly income. And the bar on the right shows how much of it is already going to other things, maybe a car payment or some credit card bills. Your new home loan EMI gets added right on top of that. Now here's the magic number. Banks really like to see that total stack of obligations stay somewhere between 40 and 55% of your income. If it creeps up higher than that, they start to get nervous, and that could put your loan approval in jeopardy.
But here's the great news. You can totally improve this number. Before you even apply, maybe focus on knocking out some of those smaller, nagging loans. And here's a pro tip. Apply with a co-applicant, like your spouse. When you combine your incomes, you're making that first income bar a whole lot bigger, which can seriously lower your FOIR and make you look like a much stronger candidate. It's a real game changer. So you've passed the eligibility check. Awesome. Now it's time to assemble your toolkit. And I don't want you to think of this as just a pile of paperwork. Think of it as gathering the essential tools you need to build your case and lock in that loan.
And here are the tools, right here. They fall into 4 simple categories. You've got your Who You Are docs, that's your KYC. Then your Proof You Can Pay docs, your salary slips and bank statements. Then the papers that prove the house is legit, and of course, the application form itself. That's pretty much it.
All right, with your eligibility sorted and your documents submitted, we get to the loan agreement itself. Now you've got to think of this as the actual DNA of your loan. It's the core code that's going to shape your financial life for years. So understanding every part of it is absolutely critical.
We talked about the EMI a minute ago. Remember, equated monthly installment? The key word is equated. It's a fixed amount, so you know exactly what to budget for each month. But what's inside that EMI is what's really fascinating. Every single payment is split in 2. One part, the principal, chips away at the actual loan amount you borrowed. The other part, the interest, is the fee you pay the bank for letting you borrow the money in the first place.
And this visual right here shows one of the most important concepts you need to get. Look at your very first EMI. The huge chunk of it is just paying off interest. Only a tiny sliver is actually reducing your loan. But watch what happens over time. That balance starts to shift, and by the time you get to your last EMI, nearly the whole payment is going towards clearing that principal. It's a slow burn, but it's powerful stuff.
Next up, you've got a big decision, fixed or floating interest rate. A fixed rate is like setting cruise control. Your EMI is locked in and will never change, super predictable. A floating rate, on the other hand, moves with the market. That means your EMI could go down, but it could also go up. It really comes down to a classic choice between stability and risk.
And finally, the tenure. That's just how long you're going to take to repay the whole loan. Now, it's really tempting to go for a long tenure, say 30 years, because it makes your monthly EMI smaller. But, and this is a huge but, a longer tenure means you pay interest for a much longer time. The difference in total interest paid between a 20-year and a 30-year loan can be absolutely massive. We're talking tens of thousands of dollars more.
So you have the map, you understand the vehicle, now let's just go over a few essential rules of the road to make sure your journey is as smooth as possible.
Here's your final checklist. First, and this is non-negotiable, always pay your EMIs on time. Set up autopay. It's the best thing you can do for your credit score. Second, really think about that interest rate choice. Know which way the market is heading. Third, live by the sleep at night rule. Don't borrow so much that you're stressed every month. And last, please read every single word of that loan agreement before you sign. It's a legal contract. Get help if you need it. Your future self is going to thank you.
So there you have it, the whole path to owning a home, all laid out. The maze is gone. What's left is a clear step-by-step roadmap. So the only real question left is, are you ready to take that first step?